Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Adam Wilk, the founder and CIO of Greystone Capital Management. Adam is a savvy microcap investor who prefers to run a very concentrated portfolio. In this in-depth conversation, we covered how Adam applies learnings from being an MBA scout to the investing realm, why he has chosen to own so few companies, the types of microcap companies that Adam gravitates toward, his approach to assessing management teams, and what it was like starting a new firm in March of 2020. For full disclosure, Adam mentioned a number of securities on this podcast. I do not own any of them. And without any further ado, here's my conversation with Adam Wilk of Greystone Capital Management. You started your career working in professional sports, specifically for a couple of NBA teams. Are there any parallels between scouting for great basketball players and looking for worthy public stock investments?
Yeah, I would say there are. As you mentioned, I started my career in sports, and to put it simply, one of my roles in the NBA was to find undervalued players or mispriced talent. And I kind of complemented that skill set by also learning how to evaluate the human component, which is obviously incredibly valuable for what I'm doing today. And I place a very strong emphasis on the people side of things when making investments. And I had a boss at the time who was excellent at both of those things. And he was a tremendous talent evaluator. And he mentored me in a lot of ways. And it's not really a transferable skill to like take what you see and, again, transfer it to somebody else. But he did a really good job of kind of teaching me what to look for. And the team that I started working for initially, the Spurs, never drafted players in the earlier parts of the draft. So they had no choice but to scout in different areas of the market than other people were doing. So even today, it may have changed because I haven't followed too closely, but most scouts spend a lot of time at places like Kentucky or Duke, where they're scouting the top prospects and they'll go watch 5 or 6 games a year. The Spurs took a very different approach because they knew they would never be able to select any of those players. And so they had no choice but to look in other areas. And that sort of idea of doing something differentiated to get a good result and trying to look in off the beaten path areas where other people weren't focusing just really resonated with me. And without kind of explaining that analogy or metaphor, you kind of understand what I'm getting at in terms of making public market investments. So I spent a lot of time searching for undervalued players, and every year during scouting meetings, we would get together and we would deliberate and we would talk for hours, and we would have a list of players that we thought would be good for the team or that could be drafted in the range we were selecting. And every year he would come in and he would look at the list and kind of sit in for a minute on the meeting, and then he would throw out a player that we had overlooked or nobody was really focusing on, or you hadn't heard a lot of like draft chatter about. And then he would give 3 or 4 bullet points about why we should consider this player and do some more work. And that was it. And every time it was either a player that the team ended up getting involved with in some way, whether they drafted him and had him play overseas, or somebody who just went on to be an NBA role player in some capacity. And I always admired that ability to just, again, see what other people weren't seeing. And I learned a lot from that experience. And one of the biggest takeaways was that the same biases that exist in evaluating athletic talent exist in public markets. And it's applied in a different context, but people regularly dismiss NBA athletes or college players who are entering the draft for reasons that have nothing to do with their actual playing ability. It could be a gut feel thing. It could be something that has to do with their body. It could be where they went to school. It could be that their stats aren't really a normalized view of how they play because their coach in college maybe didn't utilize them correctly, which happens all the time. And it sounds kind of silly, but my version of that is trying to sort of identify those types of things in public markets and find businesses where there's a good core business and earnings power can increase over time, but it's not apparent. One, based on maybe something that's happening with the company specifically, but two, because there are less eyeballs on the types of things that I'm looking at. And the high level to the story and kind of what I'm doing now is that there's, it allowed, what the Spurs did allowed them to approach scouting in a very different way than the rest of the league. And I feel as though, although I haven't had decades long run of success, I'm able to approach kind of selecting ideas and building a portfolio and making investments in kind of a differentiated way, just given the areas of the market in which I focus. And sort of closing that off is the most important thing that I learned about selecting a player that other people weren't really paying attention to is if you can create within your organization this ecosystem where a player can thrive, his skill set on day one or his abilities in college become less relevant because you know that you have the tools to develop that player into what you want him to be, excuse me. And as a result, I place a big emphasis on things like company culture and again, people, which is not always the focus in public markets. You know, Buffett obviously said when you're looking at investments, the quality of the business, excuse me, the reputation of the business should outweigh the reputation of the management team. I don't disagree with that, but in small companies, there should be a really big focus on people and culture because if you're looking for good investments or businesses that you can hold for a long period of time, the culture and kind of how the company does things from the top down really moves the needle. So that was a big lesson for me in terms of, I think, putting that as an emphasis in my process and trying to figure out how hard a player will work when they get to your organization is very different from saying, you know, he made 53 pointers in college, so we don't think he can be in 3 years or something. So we don't think he can be a capable 3-point shooter. But the better question to ask is, can we teach him to be a good shooter? And my version of that is trying to dig into incentives in terms of how hard somebody will work and trying to figure out what the management team is incentivized to do, how they're paid, what they're focusing on in terms of the strategy and key metrics to move the business forward. And then trying to figure out how that intersects with the people element, how that intersects with the company's core business and whatever competitive position they have. And then the overlaying theme is putting all that together within the small company space where, as you know, there are less eyeballs on these businesses and they can be at times insufficiently researched. So I don't know if that answers your question, but that's kind of how I thought about that when I initially heard you ask.
Yeah, I mean, I think there's a number of parallels there, and that's why I thought it'd be an interesting place to start. So as you were transitioning to the investment world, I mean, you hinted at this a little bit, but I'm curious about how you landed on small and microcap stocks. I mean, clearly there are fewer eyeballs there, but maybe it could have been international stocks. Like how did you find like kind of US and Canadian small and microcap stocks as to be a good analog for the experience you'd had looking for kind of undervalued players in the NBA?
Probably because I'm a glutton for punishment, apparently. I spent some time studying when I first started in public markets. I spent some time, as everybody does, studying, excuse me, some of the world's best investors. And I quickly realized that many of those people spent their time early on or started in small public companies. Buffett invested in microcaps, Peter Lynch, Joel Greenblatt, and the idea that there were less eyeballs on those businesses really appealed to me, and obviously the strategies of those people, among others, as well. And it just kind of sparked the idea in my mind that it could be an interesting kind of hunting ground for ideas. My background, as you mentioned, is very non-traditional. And so I think finding a way to compete against people with maybe more resources or larger funds or who approach things in a different way than I do was really important. And the small company space felt like a good way to exercise that thesis. And I like to keep things very simple. You know, these businesses oftentimes have one product or service line. The business models are very simple. It's easy to analyze the unit economics. And putting that together, when I started investing, my first sort of foray into buying stocks was among small companies, and I started to have some success there. And as I developed my strategy more in depth and my investment process, it became very apparent to me that there are a lot of really favorable characteristics that could benefit somebody like myself, such as access to the management teams, which I think is a kind of a competitive differentiator in some ways, and just being able to kind of wade in and do some primary research and maybe develop a differentiated insight about a business or what's taking place at a company that is not so easy to do with large companies. I'm not saying it can't be done, but it would be difficult to get, Tim Cook on the phone versus, there's the cell phone numbers of the CEOs and CFOs in my phone of the businesses that we're involved with. And there are various opinions about, the benefits of that, but for me, it's been very beneficial. And then I started having some success with small companies, and I really never looked back after that time period. And it's been, since I started in public markets, I think it's been an exercise in proving out why I shouldn't be in this space. And I haven't come up with the reasons yet, just given some of the success that I've had and again, sort of the favorable strategy elements in my favor. And then, the final piece I think is just given the current market structure, this is kind of part of a longer conversation, but these advantages, I think, and the idea that small public companies are insufficiently researched or there are just less eyeballs on them is not something that I see dissipating anytime soon. And as long as that's the case, and as long as the opportunity set is here where I think it is, then I think it's a pretty favorable place to be looking for ideas.
Yeah, and I believe a lot of that, and my career path is somehow ended up going in the same direction as yours. But what I'm curious about is how you went from MBA to learning about small and microcap stocks and having initial success to saying, I want to be the firm founder. I want to start my own firm. I want to start raising capital from people. What was the moment that you said, or the time period where you said, this is something that I can do professionally and full time?
It's more of a collection of moments, to be honest. I always knew I wanted to end up on my own, and then studying some of the investor greats cemented that idea in my brain. Most of them do work alone, and the idea of starting my own firm or fund was very appealing to me, and that was kind of the mission at the outset. And then I don't really consider myself as being employable, so that's the other part of things. Just extremely independent. I like to have control of my schedule, and so that played into it in a big way as well. But I spent a lot of time before doing anything related to Greystone. I spent a lot of time in the industry speaking with and interviewing people about how to be successful and how to build kind of a lasting, differentiated investment firm or strategy. And I came away from that process with a lot of great information. Most of it was negative, actually, and it kind of painted a clear picture of what I wanted to build. And I could kind of run down the list of things that I gathered during that process, but the main things were I saw people over diversified because they were more so selling an investment product than return stream. And as a result, didn't know too much about the things they were invested in. I saw a lack of focus on the actual investment work, like meaning less research and company visits and due diligence and more client meetings and board related things and phone calls, etc. And then the biggest thing was lack of alignment. So many of the people that I met with and spoke to didn't have even $1 invested in their own strategies. And among other things, I walked away from that process with a very clear idea of how I wanted to do things. And that was at the same time I was learning about the efficient markets, basically, and how the world's greatest investors kind of buck the conventional wisdom around that and do their own thing. And in order to outperform, you have to do something differentiated. So all of that sort of data, I guess, led to me just wanting to build something very differentiated. And the key insight being that I didn't think most people were setting themselves up for success or very good long-term returns. And so I thought, well, I want to do both of those things. I want to build a firm where I can think about what it's going to look like and compounding capital for decades. And obviously the returns come along with that. So I sort of landed on this idea that if I could invest off the beaten path in a differentiated way where there were some advantages, I could take on the right long-term partners and I could align our capital, meaning having myself be an investor in the strategy with most of my net worth. Um, and if I could align my capital, then I would be able to think very long-term about what I'm doing and not, on a quarterly basis or even, 1, 2, 3 year basis. And so I kind of formed Greystone on the back of that kind of handcrafted playbook. And again, I've kind of been sort of trying to prove out the thesis of the firm and also what I'm doing ever since that time period.
In that response, you talked about other investors being over diversified. You have a slide in your presentation that literally has a bullet point with the words, no diversification. That sentiment is the antithesis to how a lot of people think about investing. What are you trying to communicate with that bullet point?
I think it speaks to the differentiation of the strategy. Look, I'm trying to build a portfolio of investments that are concentrated into the best ideas, which mean the strongest return profiles and strongest risk reward characteristics. And I don't view myself as selling an investment product or building an investment product or selling a vehicle for diversification or, as it relates to whatever the broad market is doing. I have something else in the documents that says my aim is to compound capital at the highest possible rates of return. So all efforts and firm building and portfolio management related activities kind of funnel into that single mission statement. So that's the first reason. And then more specifically, or more importantly, my criteria for what I like to see in an investment is so specific that I don't come across it often. Lately, it's been a bit more, as we've talked about a little bit, it's been a bit more frequent just given what's taking place in the market. But I have a very long checklist of criteria and things that I'm looking for. And unless a company hits on almost all of those boxes, it's usually not a good candidate for a portfolio inclusion. If you consider diversification, owning 50, 100, 200 companies, 500 for the S&P, obviously you're not going to get the benefit of having your best ideas move the needle, but also given that I'm a one-man shop with some outsourced partners, it's difficult for me from a bandwidth perspective to follow all of those businesses, especially given the work that's required to own them in a concentrated portfolio. And so that's another big part of it as well, which is, I think once I get above or around the 10 stock range in terms of what's in the portfolio, it becomes very difficult for me to just keep up with the businesses in a way that I like, meaning the maintenance due diligence that's required and the following along on a quarterly basis and the conversations that I have surrounding those businesses with kind of key stakeholders and industry people, et cetera. It just is very time consuming. And there have been times when I've owned about 15 names and there have been times when I think it's been 7 or 8. But that 10 seems like the ideal number, obviously dependent on the opportunity set. And then if you break that down by weighting, I don't really hold too much cash, either at the portfolio level or kind of on a look-through basis for my partners. And so I'm comfortable with the top 5 positions making up a larger percentage of the portfolio, and the rest of the bottom half of the portfolio, I guess, is still fairly large enough to where it will make a difference and where I've done enough work and maybe can obviously cycle more capital into those names as things happen in the maybe heavier part of the portfolio. So I think it's a function of bandwidth and kind of criteria, if that makes sense.
I think this is a good time to dig into that checklist that you mentioned. The small and microcap universe is quite large in terms of the number of companies. So maybe go through that checklist and tell us what is the profile of a business that piques your interest.
Yeah, I mean, it definitely varies. I think I like owner-operator led businesses. I like businesses that are leaders in their spaces that kind of lead to durable cash flow streams. I like recurring revenue profiles, high incremental margins, the ability to grow or operate through all economic environments, or at least get stronger, and then some path to earnings or free cash flow growth and potentially margin expansion. There's no real industry or sector focus for Greystone. I mean, I get asked this question sometimes, like what sort of businesses do you like? What sort of industries are attractive to you, or sectors? And I've kind of relaxed into the idea that there's not a great answer to that question. I think if you were to look across the portfolio, for me, I mean, if you were to look across the portfolio, it's very unique in terms of the types of companies and also the industries. And that's intentional. It's really more, the bottom up focus for me is really more on an idea by idea basis, more so than any like attractive industry or sector. And having said that, I like service businesses and I like B2B companies that can maintain a leading position in their product or service niche. I don't do too many consumer related things. But yeah, I'm more focused, I would say, on company attributes than kind of like an industry or sector specificity. And if a company can hit on some of the things that I mentioned, then that's usually a good candidate to do some research around, or it's a company that I've followed for a while that has those criteria that, you know, is a good candidate to do some refresher work on. But in general, recurring revenue profiles, high incremental margins, owner operator led businesses, companies that can operate through the cycle, those are really good candidates for something to look at or potentially own.
And we've talked about your focus on small companies. What does small mean to you? And what does that portfolio composition of smaller companies, what does that mean for the total capacity that you think you could run comfortably without eliminating your ability to invest in businesses you want to own?
I think small has different definitions depending on who you ask. The definition of a microcap, for example, I think has moved around over the years, especially maybe rightfully so, given inflation. But I think my sweet spot is pretty large. It's not in terms of market cap, but the range is wide, I'll say, my sweet spot. And I would say between anywhere from 50 million to a billion in market cap is a good place to look. And while that range is pretty wide, it's a good sort of opportunity set because there's a wide differentiation of companies that obviously are in that range that have all kinds of attractive characteristics, but could be going through different life cycles of their evolution. And I like at times getting involved with really small companies, depending on the opportunity set. And then there's a company in the portfolio. There's one in the lower end of that range right now, I would say around 70 million in the portfolio. And then there's a business that has a market cap of 10 billion. The 10 billion one is probably an outlier. I've owned it since it was around a billion or two, kind of on and off over the years, and really have grown to love that business and the management team. It's an excellent company and very different from what else is in the portfolio. But what's sort of driving idea generation is, again, my checklist and my criteria for the businesses and the types of companies that I want to own. It's not super illiquid. You know, people think of small cap microcaps being, you know, penny stocks. There's a kind of unfortunate trope, I think, surrounding those companies, and businesses that are below 100 million in market cap are all terrible, or the management teams are awful and don't know how to allocate capital, et cetera. That's not been my experience. You definitely have to be selective, and there's a familiarity with that world, as you know, that I think is really important to have to avoid getting into all sorts of traps. But the average market cap of our portfolio, I believe, is between 600 and 700 million. So it's not super illiquid. It's not incredibly small. And it's, again, provides a nice, not shunning companies that get up there in market cap, for me, at least a few hundred million or above, I think is a good way to kind of open myself up to finding really good businesses. Because they do, on average, I would say, get better as the market caps increase for obvious reasons. And it also provides a nice, I think, sort of bench of companies to either put on the watch list or to do case studies surrounding, because a good situation or outcome for Greystone is finding a small business that can turn into a much larger one. Sounds like common sense, but a $50 million business that has a path to becoming a $500 million one in a large market, that's a really attractive setup, assuming you get everything else right. So I think that sweet spot is likely to, or range, sweet range, is likely to remain that way over time. And in terms of capacity, given what I said and kind of where my focus is, I would imagine that 100 to 150 million is a good spot to consider closing to new investors. I'm sure over time I'll tweak that. And again, with some larger companies are moving up into the small mid-cap space, which is not something I intend to do anytime soon. Obviously, that can absorb a little bit more capital. So that's been I've been asked that question a lot. That's been kind of my go-to answer, just looking at liquidity profiles and some of the things that I like to get involved with. But having said that, that would also eliminate my ability likely to invest in kind of the 50, 75, $100 million market cap businesses in the way that I like to. So I would say between 100 and 150 million is probably a good baseline. You know, the firm is way below that now, so that can be a good or bad thing. And there's plenty of room to kind of absorb additional capacity, but that's kind of, those are kind of my initial thoughts surrounding that, if that makes sense.
Sure. And you mentioned the phrase durable cash flows. People who are not familiar with the microcap space may be skeptical that many of these companies have defensible unit economics. What types of small businesses do indeed possess those competitive advantages that allow them to have durable cash flows?
That's a great question. I think there are examples of companies all across the portfolio that, in my view, have strong competitive positions. I don't think I could point to anything in the portfolio and say this is the greatest business or business model in the world, except for maybe one company I've started buying recently, which is, I think, the greatest business model in the world. But that's a conversation for another time. But some of the things that our companies possess, I think, that are either kind of soft or more hard moats or really advantage them in terms of their competitive positioning are long-lasting relationships with their customers, which can lead to some, based on technical expertise or something of the like, that can lead to switching costs, especially for a business that manufactures something with a high cost of failure and has a really good track record and reputation. Geographic advantages, you could also call that scale. There are some businesses that, and just leading scale is a good competitive position to have within a niche, because that kind of begets additional advantages as well, depending on the business. We own things that I believe have massive cultural advantages. There's two companies in particular that, based on how they not only treat their employees and the people within the organization, but how they incentivize their sales teams and the kind of sales culture that's built around the company, I think it, versus competitors, gives them a tremendous advantage to not only sell higher margin products and services, but to also sort of create a longer runway for themselves over time based on the way that they do things. And then in line with that, kind of focusing on a business segment or area in their end markets that competitors are not. And kind of going back to the example I just gave, approaching an end market with a different sales process that's geared more toward relationship building, or maybe not necessarily angling for the highest cost project up front. And I know this is difficult. I'm being very vague here because I'm not talking about specific companies, so bear with me. But generally speaking, attacking the sort of sales cycle in a different way, I think, has been something that over time I've grown to appreciate for some of our companies. And so there are little things like that where, after following a business for a long time, you can sort of suss out these small things that companies are doing on a daily basis that add up to kind of big incremental things over time and could lead to a real advantage. Like the business I mentioned, that's a $10 billion market cap. They have one of the best cultures I've ever seen that starts with the founding of the business 60 or 70 years ago. Those people are not in place anymore, but the new owners of the business carried along that culture. As a result, they treat their employees a certain way, which has everybody, to put it simply, fired up to come to work every day. And the way that they sell their services is very different from their competitors. And putting all that together, they've been able to organically grow their revenues, margins, and make some nice acquisitions to the point where they've 10x or so the size of the company since it went public. And that's a really good example of company doing, again, very simple things that they do incrementally better and better and better over a long period of time. And it can lead to really good results. And this is it's not software. It's not semis. It's not AI related. It's a very unsexy, boring industry, but they're just doing all of the right things, again, little by little. And the reason why we continue to own it is because there's a significant path to kind of future margin expansion and outperformance over time. So that's kind of the something that I look for in terms of a really positive outcome that worked out well. But it starts with, I think, just looking for some of those either soft or kind of hard competitive differentiators, and then figuring out how they can kind of evolve over time, if that makes sense.
If I think about the characteristics of the businesses that you described, if those things were up market cap in the mid cap space, for example, if you had those attributes, those stocks would be incredibly expensive. My guess is that's not what you see with your portfolio companies and the things you've invested in. So why would businesses like those ever be really undervalued?
Yeah, the answer to that question is because the companies are small, and there's a little bit more to it than that. The two answers to that question at a high level are because the companies are small and there are less eyeballs on them, and therefore they're likely to be insufficiently researched because larger funds can't own them. And the second part of that question is because typically, not always, the earnings power is not apparent. And the reasons that earnings power may not be apparent happens for all kinds of reasons. But those two things combined typically can lead to a mispricing. So I like to find companies where there's, again, a good core business, but it's wrapped up in a lot of moving parts. And when I can determine that the future is going to be different from the past in a positive way, that can usually lead to a really good situation. And given the current state of the market and the environment that we're in, a company that is trading below $1 billion in market cap with few or zero analysts, that has had some corporate event happen, a management change, debt refinance, strategy shift, a dividend cut, and there's something on the horizon where, again, the future is going to be different than the past. That's when you can typically find a really good business on sale. It doesn't always work that way. And in the case of the business I mentioned, they had gone public via SPAC. And for a variety of reasons, I thought investors were overlooking both the quality of the business and the growth trajectory. And there were some other moving parts as well. But in general, a great setup for Greystone is, again, finding a really good business that is not priced as such because there are some moving parts surrounding it. And with an incentivized management team in a good industry or market, that the earnings power of the company is going to grow over time. And you're not really paying anything for that today, just given, again, some of the events that are taking place. So I don't know if I'm doing a great job of explaining that, but it's really, honestly, people like to overcomplicate things all the time. It's really that simple. I haven't abandoned the idea that microcaps especially come with an embedded discount. And it's not always because of inferior business quality. It's because for the reasons I just mentioned, among some other things. And when you have that plus what I'll call a business specific event, or something taking place within the company, that can lead to a really good situation.
If I think about the philosophy you're describing and the companies you've profiled, I get the sense that this, my takeaway is that you're running like a small and microcap compounders portfolio, but you also have a place in the portfolio for special situations. Maybe you can talk a little bit about any differences in the way you view certain investments within the portfolio, especially given the time horizon that you're expecting things to play out.
Yeah, I should probably update that language, because things have changed a bit from when I started the firm. I think there was more of a focus on sort of bifurcating the portfolio that way between core investments and special situations. But now there's not really a category for special sits. It's more everything's within the core investment attributes, and I basically look for the same thing across the portfolio. But what I will say is that for most of our investments, as I was just talking about, I would say some have a kind of special situation angle, like what I discussed previously. And that's why I'm able to kind of get them at the prices I paid. And so I look for corporate events, but not as an idea generator or a tool to earn returns. Like there's a catalyst here where we could earn 20% and I'm going to make this a 5% position based on XYZ. It's more to filter companies that might not be showing their full or normalized earnings power. And I think that's an important distinction, because somebody could say that a management change, a dividend cut, a strategy shift is a special situation kind of thing, or an element, or when the company announces a new contract win, here's what the embedded return profile looks like, and here's why it's attractive. It's more like, is this a reason? Are these special situation categories reasons why I can buy this company or shares of this company at a favorable price? And when I come across a situation like that, as I mentioned, it can be a really good setup for portfolio inclusion. And there's a few examples, a decent amount of examples now in the portfolio where a company is small, it's undergoing a lot of changes. The trailing financials are no longer relevant, or they don't help paint the picture. Investors have disregarded the business because of all the changes, but because it's a small company, as I was saying previously, I can kind of wade in there and do some primary research without much competition, and come away with some idea of how strong the business is, and then know that once these things clear up, if they're issues, or as the market kind of takes wind of what the company or the management team is doing, the earnings power is going to become much more apparent and start to shine through. And again, there's a number of examples of those in the portfolio. One good one is, just at a high level, is a company who got rid of their or changed the management team and the board due to some activist involvement, brought in a new CEO. That CEO enacted a strategy shift, stopped doing this value destroying M&A that the company was doing, cut all of the excess costs from the company that the prior management team was responsible for, and then took the tremendous cash flow from the company and just returned as much of it as he could to shareholders. And that process is still ongoing through dividends and buybacks. And within like 2 years, they bought back 25% of the business. Costs came down, revenues were still growing nicely organically, and cash flow went up considerably. And it was wasn't a turnaround. It wasn't a real special situation. It was more kind of a return to common sense. And without giving away the business, there was a very durable stream of cash flows available through the core business. And it was one of those companies where like an idiot could run it, which is what happened. And the business survived and was not impaired, and things could move forward favorably. But you just needed the right person in there to kind of create actual value for shareholders. And that's what happened. But if you looked at the company initially, you would see there were a number of things running through the P&L when I got involved. So you would see a company that was under earning. You would see a CEO change. You would see an elevated cost structure relative to what they should be running. And all those things would easily, and it was a small company. It was like a $180, $200 million market cap. So all of those things, I'm very sympathetic to this, or empathetic to this, where I could approach this from the perspective of somebody who doesn't typically invest in these kind of businesses. And I could say, I could understand in 2 seconds why you would run the other way. But it takes some digging, and it takes some work and getting to know the management team and what they're going to do to uncover that this is actually, and some work on the business, to uncover that it was actually a really good business with decades-long history of profitability and cash flow, very high margin thing, significant competitive advantages in terms of not having a lot of competition, being in favorable geographies, and again, a really durable cash flow stream. And as long as that wasn't impaired, again, you just needed somebody to do common sense things to create shareholder value. And they happened to bring in the right person. And one thing led to another, and it has worked out well so far. But that's an example of, I would say, a company with special situation elements, but is something that I would be comfortable holding as a core investment, if that makes sense.
And that's a good segue to ask about your desired hold period. So in the core part of your portfolio, whether these companies contain a special situations element or they don't, what is your target hold period? What, and what have you, as you've run the portfolio for a number of years now, what have you seen in terms of how long you hold things?
I try to take a 3 to 5 year view on things when I'm evaluating a company and really thinking through business outcomes. I don't think I've had much success predicting 7 to 10 year results. And typically, the investment thesis changes during that time period, either positively or negatively. So it's not been an area of strength to do a 10-year DCF and think that I'm going to be somewhat correct on where we end up. But I try, the idea is that it's not a secret that the average holding period for most companies has come down from decades ago was 8 or 9 years to 6 months or 3 months at this point. And I try to think about things on a much longer term, a much longer time frame. And part of that is the stuff that I'm buying is what I just described. It takes time to play out, so it's important to do that. But the other part is that if a company has favorable unit economics and organic growth runway, and there's reinvestment opportunities, or the ability to return capital favorably through long-term buybacks, it's something you want to hold for I want to hold for a long period of time. And so I'm always on the lookout for those businesses. And I basically, the work that I do beforehand and the types of businesses and people that I get involved in, I would say create my due diligence or the work that I have to do, meaning they're either performing the way that I thought they would or should, or they're not. And I have to kind of tweak things over time based on what's happening on that front. But the desired holding period is as long as the company is executing in line with the original thesis while leaving room for positive surprises and revisions upward to earnings power and some of my estimates. That's a good place to be in. If you thought a company could earn XYZ in 5 years and they've significantly exceeded that in year 3, and the stock has moved or not moved, and it's either become cheaper or more attractive or less attractive. The more attractive part is a good situation to be in. Sometimes the company does become a bit overvalued and gets ahead of itself. But I'm basically evaluating things on a quarterly basis and then through kind of maintenance due diligence. And I view my job is not so much to react to quarterly reports when you're thinking a little bit long term. I think I try to afford myself the flexibility of thinking a little bit differently in that regard. But it's more so making sure that the company is doing the right things in the short term to kind of set themselves up for the long term, whether that's putting the right bench in place in terms of people, shifting their go-to-market strategy in the right way, adjusting the competitive pressures, getting a view of how the management team is thinking about the opportunity set moving forward. I think that's all work that I do during the holding period and to give me an idea of where this will fit long-term in our portfolio, if that makes sense. And that results, I think, in having no defined holding period. But again, when making an investment, trying to think about, I would say, the next 5 years in terms of growth, earnings, returns, and then calibrating that view with what's taking place kind of in the short term on a quarterly basis, through the choppy nature of what it's like to run a business, et cetera. So not a great answer in terms of not having anything definitive, but that's kind of how I think about it.
In that response, and in a recent letter, you talked about being a very patient investor. Are there processes or systems you use to determine if you're being too patient with a holding?
That's a great question. Yeah, I mean, it's all, I really, my entire process can be boiled down to trying to identify what's taking place at the business and how that relates to how it's flowing through the numbers and how that relates to kind of the long-term investment thesis. And a big part of that and a big part of the risk management process is trying to identify adverse business outcomes. And as long as it's not apparent to me that something is impairing the thesis or my reasoning for holding a company, it's usually a good candidate to kind of just let the business and the management team do their thing. So I don't know if I've ever had the problem of being too patient, I guess, with something that's working. Having said that, there have been times when I have been flat out wrong about the people involved in a company or the trajectory of the business. And I have waited a little bit too long to make a decision that would benefit the portfolio, meaning cut ties or move on. So maybe that's kind of the context of your question, but I try to be as lenient as possible, I think, when evaluating the results. Surprises happen all the time, on a quarterly basis, but I like to let things play out, and I probably err on the side of doing that more than kind of reacting to short-term things. But given some mistakes that I've made in the past, I've improved my sell discipline greatly, and I think there's a better way to kind of calibrate when I know I need to move on versus letting something play out and kind of hoping that things move in a positive direction, assuming that the investment thesis is not playing out as I hoped. And I'm happy to expand on any of those things. I don't know if that answers your question, but it's a very interesting one.
No, I think you answered that well, and again, you bring up the people part, which I think is really important, and your inoculation into the Spurs culture taught you about how important the people were on the sports side. I learned the hard way that management is incredibly important when investing in small companies. What is it that you proactively look for when it comes to management? We can talk about red flags all the time, but maybe the better thing, especially given, your multidisciplinary experience in evaluating people, I'm curious about what you actually look for.
Yeah, first and foremost, I want to invest alongside people who are treating our capital like their own. And that phrase, unfortunately, has become a bit overused, but it's still not no less effective. And that's a very strong focus for me, whether it's an owner-operator-led business or not. Oftentimes it is their capital because the people founded the business or they've been with it for a long enough time to own a significant amount of equity. And that's probably where I start, just getting a sense for how they've made decisions over time and what they're likely to do in the future. It's a very hard thing to do. It's an imperfect science, but that's kind of the first thing that I look for. Outside of that, or in line with that, I need to see large equity ownership relative to base salary. That's very important to me. There are exceptions, of course, but that's another big box I'd like to check. Industry experience has become really important to me. Being shareholder friendly and having very open lines of communication is important. One very big part of my process is to get to know the management teams that we're invested alongside. And so kind of black box thinking and communication is sort of a no-go for me. I do like situations where companies don't communicate with sort of the broader investment universe often. That's fine. Certainly have had my fair share of those situations that have worked out very well. And looking at a business right now where that's the case, but are very open kind of on a one-on-one setting or smaller group setting. That's very attractive. And I've been placing over the past few years, I've really been placing a much greater emphasis on track records and a long-term operating histories. That's become really important to me. Most of this list and these boxes I like to check, honestly, is born out of mistakes and things that I've gotten involved with people that have not worked out well. And I've had a lot of time to reflect on those things. Like you mentioned, we could talk about red flags all day. But I really want management to be A+ and check the boxes that I'm looking to check and avoid all those common pitfalls or red flags that I'm sure you have in mind. Outrageous compensation, entrenched thinking, long history of value destruction, all of those things within small companies usually point to very bad signs. They're red flags and they point to really bad outcomes for shareholders, and they're very, very difficult to change. There have been times when I will get behind someone who is interested in changing those things and owns a lot more stock than we do, or who's spearheading those changes. That's rare. I'm not a huge fan of kind of the activist type of thing in terms of being able to find kind of sustainable generators of returns there in terms of ideas. But there's enough red flags that I've seen, enough mistakes that I've made to where the list that I just kind of read or gave, rattled off are really my non-negotiables. And typically, if those pieces are in place and I've gotten to know the people over time and they're good people, it's a pretty good setup to kind of get to know the business a little bit better and at least know that when trouble happens, they'll face it head on, and we will be getting some kind of honest response or communication about our investment and what's taking place at the business. And that's a good way to kind of follow a business along and kind of evaluate investment over time.
And you mentioned that once you get above holding 10 stocks, you felt like it's a little bit too much work for a small team to work on or to cover properly. I know you, I think, have a watch list that's as many as 50 stocks deep. I'm curious how you, with your outsourced partners, find the time and the bandwidth to, keep your new idea list fresh and cover as many as 50 stocks on a watch list.
Yeah, it's difficult. I think the watch list is probably bigger than that at this stage. And I think just having done this for over 12 years or something, there's a lot of companies that I've followed for a long period of time and that I've gotten familiar with and have either owned or would like to own or just am interested in terms of the business models that I think it's important to keep up on. So I spend a lot of time outside of portfolio management kind of working on that list. I think it's not only been a good source of ideas over time, but it's nice to just keep up with those businesses because on a yearly basis, as volatility takes hold, you can be presented with really favorable entry points for some of those companies, and the due diligence or getting up to speed kind of maintenance work isn't as intensive as a brand new idea or industry. So that's a big part of my process, I think. And when people ask about idea generation, I typically reference the watch list as a good place to do it. And it's kind of just a manual, labor intensive process. It's following the businesses, updating my view of earnings power over time, if necessary, speaking to the management teams, kind of doing what I would imagine most people do, staying up to speed with the industries, reading the expert calls, et cetera. And then for a select group of those companies that I've gone a little bit deeper on over time and maybe am waiting for the right price or just don't have room in the portfolio, there'll be additional kind of work done that I'll either try to outsource or do myself. And it's really just a constant running, again, labor-intensive manual process of just keeping up with the companies and making sure I'm not kind of missing anything interesting that's happening. For example, a company that enters into a new product or service line, that's something they've never done before, or some accelerated growth that is eye-popping at first glance, or a significant share buyback program if a stock is cheap, something along those lines where my ears kind of perk up and I say, well, this company's been on the watch list for a while. I know it. And now it's maybe time to dig in a bit and see what's taking place. So it's kind of a combination of high level, keeping up with everything as much as I can, and then eventually like pouncing on something and really diving in when something interesting pops up. But with there's maybe 120 or so businesses on the list now. So it's become, I should do some pruning maybe is what I'm saying, but so it's become difficult to really focus, stay on top of it. And I've been lucky to have to utilize the help of some great interns in that regard. But it's also a process I found that is best suited when I'm sort of commandeering it, because that way the information goes directly to me and the context is there. Meaning if I followed a business for years and there's a huge share buyback plan in place or something, that information will look differently when I read it versus when it's presented to me, kind of thing. So getting into the weeds now, but it's just a labor intensive manual process. And I try my best to keep my head above water in that regard throughout the year.
You talked about taking advantage of volatility. You wrote your founder's letter for Greystone in March of 2020. What was it like starting to brand the firm and invest in such a volatile environment?
It was scary. It was fun, but also scary. I think given what was taking place at the time and kind of the expected range of outcomes or unknown range of outcomes for that period. The plus side is, I think my track record got off to a great start as a result. We were obviously presented with significant bargains on day one or almost day one. And I had a sort of day one portfolio ready to go, which was helpful. And then like all of a sudden everything just became super cheap. And it was kind of like for a year and a half or whatever the period was, just everything that I touched worked. And I probably, unfortunately, attributed some of that to my own doing or skill, which was not the correct approach. We were in a massive bubble toward the end of 2021. But the importance of writing that letter not only communicate to prospective investors what I'm doing and what I'm trying to accomplish and how I think about things, but it was also to communicate that whatever's happening in the world broadly, these are kind of the principles that I'm going to stick by, and here's what I'm looking for. And this philosophy and the strategy that I'm enacting is not going to change throughout all of that. And it was an interesting time, as you mentioned, to push that out to the world and present that because things were changing. There was a massive macroeconomic event taking place and things were changing very rapidly. But it was a good time to put that into practice because from the day I launched the firm until now, despite what results have been and despite how difficult the environment for small companies has been over the last few years, nothing has changed about my strategy. And there's been some element of waiting to have some of these bargains or have some of these bargains recognized or waiting for the intrinsic value of the portfolio to catch up to a reasonable level where I think it should. But it doesn't mean I go searching for any mega trends to invest in or AI related things or anything that's out of my circle of competence or what I'm trying to do with the business. So I have a copy of, not the whole letter, but I have a copies of pages of those letters that are on my walls and some other guiding principles and stuff that I refer to often and I get to look at every day. And so that those serve as kind of the guideposts for my decision making. But maybe I would probably not wish for a similar environment at any time soon in terms of the speed or magnitude at which stocks drew down during that time. It definitely provided a lot of good opportunities, but it was just scary given the, I think, again, given the range of outcomes at the time.
And so you're 4.5 years into it so far. If we're having this conversation on the 10-year anniversary of Greystone, what would success look like to you?
I would love to be in the same place, doing the same thing with a group of like-minded partners that I really enjoy working with. And that is maybe a cop-out answer, but that's maybe as narrow as I would slice it. I think operating Greystone has been the most fun thing I've ever done and the most intellectually stimulating and the most difficult. And wrapped up in all of that is just my happiness and gratitude with the decision that I made to kind of launch my own thing. But the key to this entire operation, as with a lot of fund managers, are the people that decide to invest alongside of you. And without those people who have thankfully stuck with me through ups and downs so far, I would obviously not have a chance to do that. So I'm incredibly grateful for that, but I'm also very happy that I've kind of filtered out the universe so far with the right people. And I have kind of said, I say this to prospective investors, and I've said this from day one, which is I'm optimizing for two things: compounding capital at a high rate of return and taking on the right people. And as long as that continues to happen, I'll be happy, whether it's 7 years from now, 10, 15, and I should spend more time pondering that question, but I've had my head down or shoulder down, just kind of barreling forward over the past 4 or 5 years. And I just am glad to be doing it alongside the people that I can do it with.
We've talked a lot about the inefficiencies that you see and the opportunity set, but I always like to close really nailing that point. So we'll finish with the question we ask all of our manager guests, which is, what is the most underappreciated aspect of the investment opportunity in front of Greystone today?
Yeah, it's a great question. I think there's a very simple answer to this in my view, which is something I've been saying for probably years now in letters and through various meetings and conversations with investors, that the current market environment, the way that the current market is structured and the environment that we're in right now has presented massive opportunities for active managers, for stock pickers, and for people investing in small public companies. And the rise of passive investing and quantitative-based strategies means that the industry has shrunk a lot, and there are significantly less people trying to find value-based small public businesses. And as a result, there are, despite what people think about lower quality companies, small companies being lower quality and more highly affected in a downturn and less recession resilient, somebody like myself, I am the professional who, like I was in basketball, the guy who goes in and finds undervalued talent and mispriced opportunities. And that means I search for the quality ones, not the ones that make up sort of the average or the reputation that I think small public companies have. And so I don't even know if this is underappreciated at this point, but the runway for very strong returns in this arena, I think, remains very, very strong. And I've yet to see in size people kind of turn the corner on that understanding or idea. And I think it's very interesting because there will be a time period when it does turn. We might be entering an economic downturn, and we'll see what comes out of that. But whether we do or don't, there will be a period where that turns, and value-based, stock picking, focused, quality company strategies, I think, will shine through at some point. And again, I don't think that mindset has been kind of adopted widely, and that might be the most underappreciated aspect, but there remains, in my view, a very long runway for finding these types of businesses that we've discussed today and for compounding capital in this area.
Well, given how painful it's been to be a small and microcap investor over the last 5 years relative to investing in the S&P, for example, I think that remains a very contrarian perspective. And I'm rooting for the same thing, some reappreciation of smaller businesses that don't play in the sexy areas of the market. So Adam, this has been amazing. Thanks for sharing your story and your journey, and also going so deep into the philosophy and process. I think everyone's going to really enjoy learning about that. Thanks for being on Compounders.
Thank you so much for having me. This was great. It was a lot of fun. I appreciate it.